This is a CPI trade, so much more aggressive. This is less technical. This is about the aggression in executing the trade. So we're looking at the S&P and Euro stocks on this trade. You see the difference here as well in terms of the size. What he's doing is he's somebody who's taking very quick, very aggressive trades. So what's happened? Data comes out. S&P has volatility stopped, so you can't trade the S&P now because you can't enter. So S&P is trading higher. Enters Euro stock, very aggressive. It's 30 contracts straight in the Euro stock. S&P now reopens straight in, straight out. That's around about 40 big ticks in the S&P on 6 lots very, very quickly. But that's an in-out. He's now looking to play the Euro stocks. It's about understanding the correlation. Here you go, a bit of use of footprint on this. One of the things that he does do is he will bring in a footprint. The idea of footprint here is to protect him on the trade, is to be able to say, right, he's in there. Where is all the volume getting done? So as he starts to see this building up of volume, seeing that no one's able to trade below this zone, which runs down to around 71, he's then able to look at that and say, right, I can stay in this. So it's less about trying to say, oh, I don't like it, I'm not sure. You're using the footprint to say, right, I know where I'm wrong. He knows that he is wrong. You come out of that zone, he's giving this up at probably around 66 area. It's nice small risk on the trade. Very quick entry, small risk. Is relying on the footprint and the way that it builds volume up there. Whoops, before that disappeared. The way that it builds volume to enable him to stay in the trade looking for the next move. So whilst he is much more aggressive, the technical skills that he learned early on in his career from those detailed early debriefs are now allowing him to sort of bring that into the very aggressive nature of taking the trade on here. So this one where he's now sat through that phase, so it's sort of steadily ticking forward, waiting for the action to happen. And this is where the patience has to come in. So whilst it's very aggressive to start with, it's much more kind of now considered and planned out. And this comes from, you know, replaying and rewatching and re-going through each of these types of trades. Quick on, do news trades require aggressive execution such as market entries, or does a limit or stop order work? I would never use a stop order on a piece of data. You lose all control of where you get filled. It's a gamble. It's a punt. I've seen people do this. They will use a stop buy and a stop sell ahead of data. And what happens in the bad situations is they get hit on both and they get slipped one way, slipped the other way, and lose the bit in the middle. I've seen people lose careers doing that. Don't do a stop entry on it because you run the risk of immense slippage and a market whipping you both ways very quick for a huge amount of money. Don't do that. You are likely to have to use a market entry, absolutely, but know how far you're going to pay up. So rather than a market entry, use a limit entry and hit market. So what I mean by that is you get your mouse, you hover your mouse, say here, meaning that if you hit, you won't hit higher than that price. And if it jumps over it, you'll miss it. But that's better than them paying way, way too high. So that's the idea behind the trades.